for small business. We've got a little list of an agenda here that we can run through. Maggie, if you've got the slides there, we'll jump into that first one. So this is going to be the run of the show today. We're going to get into some key numbers to know, and we're going to be just reviewing very quickly a tool that ATB has called the Small Business Pulse Check. And then we're going to jump into how to build or maintain your credit rating. Maggie's going to talk on that topic. Then it'll come back to me, and I'll talk a little bit about when to look for a business loan, what's the timing around that. And then we'll give it back to Maggie to talk about the nuts and bolts on actually getting a business loan. How do you qualify, and what does that process look like? So by the end of it, you should have a pretty good, hopefully a bunch of tips that you can take away and help to grow your business. So before we get into it, we'll do a couple introductions. So maybe Maggie, I'll throw it over to you to let us know who you are.
So I am a business advisor. As I said before, I'm born and raised in Lac La Biche, so I'm very excited to get to support this market going forward. I have been in the financial industry for about 3 years now, with ATB for just over a year. I have quite enjoyed getting to learn the ATB way and getting to be a part of their family. I can do anything for your small business as long as we have lending underneath $250,000. If we have a little bit more lending than that, you'd go up to relationship manager. But my expertise is supporting those small and growing into medium business clients and making sure that we are supporting your growing business in a way that you require.
Right on. And then, for those that I haven't met, my name is Cliff Turner, and I'm an entrepreneur ecosystem strategist with ATB. So even though I work for a bank, I'm not a banker. I don't have the expertise that Maggie has on the nuts and bolts of putting all this stuff together for you. I'm more of a general business strategist. So I've kind of been part of this Alberta small business ecosystem since about 2005. I've had a few different businesses. The last one I sold in 2019 was a roofing company. And just lately, I've launched a tire service here in Edmonton. So always dabbling in the entrepreneurship side of things. But for ATB, my job is really to be a thinking partner and a guide and a connector for small business owners. So I spend a lot of time out in different communities just finding what resources exist for entrepreneurs and then just helping people get connected to those. So that's my role with ATB. Now, we both, Maggie and I, tie into what we lovingly refer to as our entrepreneur centers. We have 2 physical locations. There's one in Edmonton and one in Calgary, but we also have kind of an online presence for that. And Maggie, if you hit the next slide there, there's a QR code that'll take you to that part of our website. So the QR code will actually take you to sign up for our newsletter, which I'd encourage you to do, but you don't have to. Up in the top, you can scan the different resources that are available. But what you'll find on our website is just a lot of different tools, from articles and pre-recorded webinars, templates and guides, one of which we'll be looking at today. And of course, our newsletter that you can subscribe to. And from that website, you can also connect to business advisors like Maggie if you do have questions or something like that. But Maggie and I will be sharing our information at the end of this presentation anyway, so you can have a direct line to us. Like I said, a QR code will take you there, or you can just visit atbentrepreneurscenter.com and it'll take you to the right part of the website there. So without further ado, let's dump into the actual topic. So we'll first be looking at these key numbers. Now, you hear it all the time, know your numbers, right? And Maggie, if you jump onto the next slide there, you'll probably see, you might have to click it a couple of times. Sorry, everyone, I was supposed to be doing this and my computer's being weird. So Maggie's got the honors of controlling it. But you hear it all the time, know your numbers. It's on Dragon's Den, it's everywhere. But then you see all these different ratios, formulas and things. It's like, well, which numbers? Nobody's going to keep all this in their head all the time as a business owner. You've got a business to run, right? So you can end up looking like the confused lady in the graphic there. I look like her all the time running my business, so I know how it feels. And really, it's like, what numbers are actually important for the day-to-day of a small business owner? And that's what we're going to talk about today with the Small Business Pulse Check tool. So the Small Business Pulse Check tool, which is the next slide, sorry, Maggie, it's basically been designed to give you a way to just keep a kind of a pulse check on your business as you go about your day. but by not taking up a lot of time every month to try to dig deep into your finances, because not a lot of people who are running a business have that time, right? So the idea of this tool is to give you something where if you can dedicate maybe an hour and a half every month to running through this tool, it'll keep you on top of your business and keep you to know the important things. Now, it's actually built into three parts. There's a financial pulse check, a strategic pulse check, and an operational pulse check. Today, we're only going to be talking very surface level on the financial pulse check. But that QR code will take you right to an article that'll give you the in-depth knowledge on how to use that tool and what it can do for you. I think I've actually presented the full financial pulse check to John's audience before, so you might want to look on their YouTube channel, and you can find a more in-depth presentation on this. So today we're going to keep it pretty surface level. But what the financial pulse check does is it basically narrows it down to 6 numbers that you should know at the beginning of every single month. And if you know these 6 numbers, you'll probably have a really good sense of where your business is at and where it's going. And the idea is, like the guy in the top picture there, to give you a way to just have a general health check on your business. So he's probably checking his pulse and his heart rate and things like this, blood pressure maybe, and he can track that month to month, right? And then if that starts to go off, if he sees, hey, my blood pressure has been up the past couple of months, maybe I need to go talk to my doctor, the lady in the bottom picture there. And in the small business world, of course, that would represent maybe your accountant, your marketing person, whoever it happens to be in the situation. So the pulse check is like wearing that Fitbit, just keeping you on top of things and giving you a flag, I guess, if maybe it's time to go and see the doctor, the accountant, or whoever it happens to be. So the 6 numbers that we're going to track through this, 2 of them you probably already know off the top of your head. On the next slide there, you'll see that we have got the first one is your revenue for each month. I'm betting if you're anything like me and most of the small business owners I know, you probably already know what your revenue was last month, just your gross revenue from your business operations. When you go into the pulse check tool, it's going to let you put that in. It'll start graphing it for you. And it's very simple, this one, because it's graphing it just as a dollar amount from month to month. The reason we want to know what that is just very generally, what is the business doing over the course of a year? So it'll show your seasonality in a visual sense. If you run a promotion, it'll show you exactly what that did gross revenue wise for that month. It'll just give you that general idea of where your business is going as far as how much money it's bringing in. So that's an easy one. That's number 1. Number 2 is your gross margin. The tool will do the calculation for you, but in case you wanted to write it down, that's the calculation for gross margin right there. If you run a business, you're probably familiar with this calculation, but what it basically does is it shows you the value that you're getting from your inputs or your costs of goods sold. We use the COGS acronym throughout this presentation. So it's basically saying, from all the stuff that I buy to provide the service that I do, or to provide the product that I do, how much value am I actually getting out of that stuff? When I do the full presentation, I usually talk about an example of a lady who does dinette sets out of her garage. And we use that to go through this whole tool. And so in this case, she'd be looking at how much is the wood that she has to buy, the fasteners, the glue, fabric if she's doing upholstery on the chairs and things like that. And then saying, well, I buy all this stuff. How much am I getting back out of it? That's all that this calculates. So all it is doing is taking your revenue and your costs for all those inputs, and that's giving you your gross profit. And then we're just dividing it by revenue times 100 to get a percentage. Now, it's important that we do this one by percentage, and the tool does this calculation for you. So all you need to know is your cost of goods sold number. But the reason we want to do it by percentage is, first of all, it smooths out seasonality. So if you have a busy month and a slow month, those might look really different when it comes to gross profit. But if you condense it to a percentage, it'll smooth that out and kind of give you an idea, no matter how busy you are, how much value you're getting from your inputs. The second reason that we do that as a percentage is that it's very easy to compare to your industry. So if you can find businesses that are kind of similar to yours, doing the same thing and maybe a little bit bigger, maybe a little bit smaller, your margins should be about the same if they're all healthy. So you can kind of take that margin, look at your industry averages and go, am I average? Am I above average? Maybe I have some improving to do. But it's just a nice way to kind of give yourself a sense of where you sit within the industry. So that's number two, your gross margin. Number three is very similar. It's your net margin. And again, the formula will pop up on the screen there for you. So all we're doing is going one more step with this one. This is going to show us the efficiency of your business as a whole. So we're taking your revenue, we're subtracting your cost of goods sold, and then we're also subtracting all your operating expenses to get your net profit. Then we're dividing that by revenue times 100 to get a percentage. And again, the tool does this for you. You don't have to worry about remembering the formula. But it's kind of the same reason that we track this one as a percentage. We want to get rid of seasonality as much as we can. Then we want to be able to say, okay, how much efficiency and value am I getting out of the business as a whole after I've paid everything? And how does that compare to my industry? So by the time you have these three numbers, you've already got a pretty good sense of where you're going as far as how efficient your business is with how it uses its inputs and how it's operating on the back end. Now, again, these are very general. So if you see that your gross and net margin are trending down, or maybe one's trending down and the other isn't, that might be a time to start asking questions. Why is this happening? What has changed? What decisions have I made over the past month that is sending these things in a direction I don't like? Or conversely, if they're starting to go in a direction you do like, start to ask yourself, was this on purpose? Was this by design? If not, what happened? Can I recreate it? So that's what the pulse check tool does for you. Is it, if you update it every month, it just graphs it out so you can see it visually and start to know, hey, here's a flag, green or red. Maybe I should start asking some questions, talk to the doctor possibly. So that's the first three numbers. The second set of three are slightly different, but just as important. One that I encourage people to always know, and most of us do this anyway in our personal budgeting and in our business, is our accounts payable. How much money do we have that needs to go out to our suppliers or our service providers that month? And of course, do we have the money available for it? This is something that should be checked every single month at the beginning. And again, you can plug this into the tool and it'll graph it out for you every month so you can see how that's playing out. But I always encourage people, when you do this, ask yourself if you're using the payment terms that you have available to you effectively. You can get kind of creative with these things sometimes. So this is just an example that may or may not apply to you. So let's take our dinette set person as an example that I was talking about before. Let's say that she goes out and she buys a whole bunch of wood for the next bunch of sets that she's going to build, but she's got 60-day terms with her supplier. So she can pick up that wood, she can start building tables, does not have to pay for that wood for 2 months. Now, if she wanted to just keep things simple and have peace of mind, she might want to pay for that wood right on the day that she picks it up. And that's totally within her rights to do, of course. But she could wait that 60 days, right? Now, if she's really playing her cards right and say that she has an ATB MasterCard or a credit card from anywhere, this works with any credit card really. If she's paid that off by her due date every single month, she can basically work another 20 to 30 days of interest-free financing onto her credit card. So what she could do is wait that 60 days, pay with her credit card, and now, until her next payment is due, that's actually interest-free money, as long as she's paid it off every month, that she can extend that by. So now we're pushing almost 3 months where that money doesn't actually have to be turned over when she pays that credit card out of her operating account. Now, what could she do? Let's say that it's a $5,000 bill. What could she do with $5,000 over 3 months that would expand that money? Maybe she wants to put that into some marketing because she knows a busy season is coming up and she could book 3 more tables, which will pay for that bill twice over. She could be creative with it as long as she's being strategic and safe with it. So that's just something I like to encourage people. When you're looking at your accounts payable, know how much is out there, but understand the timing and how you could use that to your benefit. Your situation might be very different, but this is something, if you wanted some advice on that, you could contact somebody at ATB, like Maggie or myself, and we could kind of look at it with you, talk you through it. So that's accounts payable. Know that number. The next one is accounts receivable. So basically the other way around. How much money is out there that your customers owe to you? Now, this one I find a lot of small business owners fall into, especially if they offer a service where they're invoicing and payment doesn't always come right away. If they own, a retail store or something, that's pretty easy. The cash just, they're paying as they take the thing, so you don't have to worry about it. But if you're in, say construction or consulting or something like this, and you're invoicing people, accounts receivable can start to stack up. And honestly, the biggest reason I see for this is that small business owners sometimes don't make it easy for clients to pay them. Um, so, as an example, I see a lot of times where somebody will send out an invoice, it's just a PDF with the amount owing and maybe some instructions on the bottom of how to pay. If you want to pay by e-transfer, send to this address. If you want to pay by credit card, stop in or phone us or whatever, which is all fine and dandy. But what usually happens with that is somebody sees it and goes, oh, yeah, I need to pay that bill. And they put a star on it in their email, and it just slowly disappears in the string of emails that they get over the next few days. And they forget about it. And then they get a reminder. And again, they start. It can go on a long time like that. And if the business owner isn't comfortable making that phone call and saying, hey, you know what? You owe me some money. When can we settle this up? That can drag on and on, making that accounts receivable number quite ugly. So really think through how easy is it for a client to pay. If you're using any kind of accounting software, you probably have an option to have invoicing process through there. And they have a nice little button right in the email that says pay now. And people can click that, it takes their card information, boom, you're paid. If you don't have access to something like that, or you're looking for different options, again, you could talk to Maggie about this. We have a lot of cash management solutions that might be a nice fit to get you where you don't have to make those nasty phone calls, because we can make it easy for clients to pay you. But bottom line for this, know your accounts receivables. You should always be aware of how much money is out there that should be in your pocket and what is your plan to collect it. And the last one is very much like the first one. You probably have this in your head already, is your cash on hand. And by this, I mean unallocated cash on hand. So this isn't money that's due for your GST remittances or your payroll remittances or for the project that you have planned for next, in the spring or something. This is cash that isn't earmarked for something. You should know what that number is at all times. Reason being is that like cash flow is kind of the king, right? So if an opportunity pops up, you need to know, do I have the cash to take care of this? Or if maybe a fire pops up somewhere that you need to put out and you got to throw some money at it, you'll know exactly what you have at your disposal. Um, at the same time, like these other two, when you look at that number, ask yourself if you're using it in the wisest way possible. If it's a few $1,000s you have sitting in your operating account, that's awesome. It's nice to have that little cushion there. But if you've amassed a bunch of money in there, you've got $50,000 or $100,000 just sitting in an operating account, ask yourself how you might be able to use that wiser. Is there a way that you could keep it fairly liquid in case of emergencies, but be gaining some good interest on it? Again, Maggie would be able to walk you through some options with that kind of thing. So basically, if you know these 6 numbers and you put them into the tool and you get the visual of where all these numbers are going, you can really stay on top of the general health of your business. So knowing your revenue, your gross margin, your net margin, your accounts payable, your accounts receivable, and your cash on hand, that's basically your Fitbit. And if any of these numbers start to go off the rails, you know to talk to your doctor. So again, we'll put that QR code back up on the screen on the next slide. I'd really encourage you to take a look at that tool, see if it would be handy for you. If you have any questions, feel free to contact us after. We can walk you through how to set it up in the way that's most beneficial for you. But it is there, and those will be some great numbers to track and just keep yourself on top of your business. And with that, we'll throw it over to Maggie for the next section.
Okay, so I want to talk about how to build your personal credit bureau score and why. Why does your personal score matter when it comes time for your business to get loans? And that's one of the main questions I find I get as a business advisor. So I always want to make sure that we are kind of addressing that question at the start. So there are different types of credit on your credit bureau. We've got our open credit, which is things like your TELUS bill. That is just can be repaid at any time as long as it's in the 30-day window. You've got your revolving, which is flexible repayment. That's your lines of credit and your credit cards. It is credit that is meant to revolve monthly or annually and go back down to zero, but that balance is still there for you to use as you need it going forward. New to your credit bureaus actually is mortgages. So mortgages are now also being put on your credit bureaus, and that just shows that you are making this installment type loan with equity attached and that is being paid as agreed, similar to below it your installment loans. So this is our loans with a fixed repayment on a set schedule. So your vehicle loans, your student loans, any type of personal loan that you have with an FI, financial institution, or another creditor, that would show under installment. And then we have our collections. So any delinquent account that had been sold to a collections agency would show on your credit bureau as a collection underneath that section. So the reason why I want to explain all of these is because they do affect your score in different ways. And it's nice to know what this looks like on your credit bureau, especially because when we are clients, we don't quite see what that bureau looks like to our lenders. So I always want to make sure that I'm putting you back in the driver's seat to understand, what does my credit bureau look like? What do I need to work on? And how does this affect my future business lending? So when we're building our credit, we want to make sure we're looking at our utilization. This is one of the big things that can impact your score. And so what this is any balances owing on your revolving trade lines, your line of credit, your credit cards, and how much of that balance you carry every month. So we want to see our utilization below 35% if possible, because that shows that while you are using that line of credit, we are not maxing it out every month, and we're not needing more than that 35% to kind of cash flow our personal lives. So I always suggest, if you can pay it below that 35% every month before your statement is posted, that is the best use of that credit, and that's going to help impact your score and grow it as you use that card. We also have your payment history. That's another big impact on your score. So are all our payments made on time as agreed? Are there any payments owing over 30 days? Are there any payments owing over 60 or 90 days? As we have those late payments reporting, those do bring down your score. And the more of them we see, the more that speaks to your repayment character as a personal lendee. So we want to make sure that, are your personal obligations paid on time? Are we tracking our personal cash flows in a way that if we aren't going to pay it on time, we can mitigate so it's paid within, let's say, 30 days late, and we're not hitting those 60 or 90-day lates? Those will show on your credit bureau for 5 to 7 years. For me as a lender, I am mostly concerned about the last 2 years. So when we're writing a loan, if we have late payments from 5 years ago, I'll make a note of it. But if it's within the last 2 years, I'm going to ask you, hey, what was going on in your life at this time? Of course, we all know COVID just happened, so we're still seeing the impacts of that. And I always want to make sure that I'm getting the best history behind it so that we can mitigate that and say it was a one-off, there was a mitigating circumstance, and we can make sure that that was a one-off and not, let's say, a pattern of behavior going forward. And then we also have the size of your credit file. So as we're getting into new businesses, or we're just getting out of school, we're going to have what we call a thin file. And that's not necessarily a bad thing. It's just hard to lend to. So the reason why I went over the types of credit is because we want to see a varied type of credit on your bureau. We like to see an open, an installment, and maybe as well as a revolving. And that shows that you're able to manage all different types of credit, as well as making those payments as agreed. So how many trade lines are reporting? Well, I could see a mortgage, I can see a line of credit, I can see 2 credit cards, and then we're going to look at what were the history of those payments. And when we have a small file, we don't have all that information to base that payment characterization on. So it can be a bit harder to lend to, but not impossible. And then another thing is inquiries. So anytime you give someone permission to pull your credit bureau, that is a hard pull. So how many times have you applied for credit in the last few years is something that lenders will look at to see, do you have credit seeking behavior? If so, what are we seeking credit for? Are we just trying to get a better rate on our cards? Or do we have a truck we were looking to purchase and getting a better rate? Just trying to understand how you use your credit, as well as how many times have you tried to apply for credit. So what we have is a hard pull, and anytime your credit bureau score has been pulled by Equifax or TransUnion, it can pull your score down by about 5 points each time. These do stay on your credit report for about 2 years, but they do stop affecting your score after a few months. So I always like to caution people, Do you know how many times your credit's been pulled in the last few months? Are you okay if I pull your score going forward? And one thing I like to do as a lender is I wait till everyone's given me their information back before I pull those credit bureaus. So that way we don't have, let's say, a mind change happen after the credit bureau has been pulled and you've been dinged if we don't want to proceed with a loan. So that's one thing to think about, is how often am I applying for loans and how often is my score getting pulled? Another thing is public records. So when I spoke about collections, these are things that are under the public records section on your credit bureau. Things like bankruptcies can stay for up to 6 years after the date of discharge. Same thing with collections, but that's after the date of last activity. So that's either last payment made or when the loan went delinquent. Those can stay for 5 to 6 years on your credit bureau, even after they've been paid. So when I'm lending, I always like to ask, do you have anything that's a concern on your credit bureau? Well, it's not a dead stop. It can definitely put a halt on any business lending until either the collections have been paid or the bankruptcy's fallen off, or if there's nothing else we can mitigate it with, then that can sometimes stop you from proceeding with lending. So I always like to make sure that we're aware of exactly what's going on with those collections and your bankruptcies, as well as if we do any consumer proposals. That's often the best way to avoid a bankruptcy is to do a consumer proposal, because they do fall off after 6 years of debt paid, or if they're unpaid, again, goes back to those 6 years. So trying to understand, what does a late payment look like, when does it cause concern, and when would that fall off your bureau, will definitely help your score. And then great question is, why does your personal credit bureau matter? So if your business is new, it won't have its own credit bureau history yet. And we won't be able to pull that corporate credit bureau history until about 2 to 3 years into your business being established with lending. And for some small businesses, like a sole proprietorship, the owner is the business. So how you make your payments determines 100% how your business will make its payments going forward, because you are the business. And while businesses itself is a borrower, the shareholders are also listed as co-borrowers in a joint and several manner, meaning that you are a joint co-borrower with your business, but you're also severally liable for that loan. So let's say the business goes under, you as a person, you're still liable for that business debt going forward. So we always want to make sure that that's why we're looking at your personal character of your payment history, as well as can the business going forward support this loan. So how does a business credit bureau report different from a personal one? They contain a lot of the same information. The business one just has a little bit more information about things like suppliers, supplier relationships. How often do you take to pay those suppliers back? So that's the accounts payable that Cliff was speaking to earlier. It'll also show any business loans you have, where you have them, repayment history, and it will also show any judgments or legal actions by the business. So let's say your business was involved in a court proceeding, that does get registered on your corporate bureau and will also tell us what the result of that was. So let's say you were just a witness, won't affect you going forward. If there was a judgment that you lost, that would show on your bureau, and that's something we would have to speak to, if not work on going forward. And back to Cliff.
Maggie, someone asked a question, Ron. Does the number of credit cards affect the credit score negatively? If all paid in full each month?
No. So actually that would help. If we have more credit cards on the bureau, that would speak to that thin file showing that we have multiple credit cards across. We were approved for multiple loans. And if they're paid in full each month, that also helps your credit bureau with utilization. So it's not a bad thing to have multiple cards by any means. It definitely goes hand in hand with utilization though. Let's say we have 5 cards, all with 80% utilization. It's not a stop to your loan, but it is a red flag as to why our utilization so high. Are we having trouble bringing those balances down? And what can we do to bring that balance down? And maybe that's something we can work on within the credit we're doing and make it more of a consolidation. So not a bad thing, as long as we know what is being left on those cards every month and making sure that there are no late payments and that we're keeping utilization as low as possible.
Okay, thank you.
Right on. So the next section, we're going to just get into talking a little bit about when is the right time to get a small business loan, and by this I'm talking about a term loan for a piece of equipment or something like this. So I'll talk through that, and then we'll go back to Maggie to talk about the nuts and bolts of actually getting one put together. So the first thing to consider when you're thinking about a business loan is just a general rule of thumb, and this is what the rest of my section here will be based on. So when you're considering a loan, basically your business opportunity needs to outweigh the debt of that opportunity. Pretty simple, right? We're going to get into the nuts and bolts of what that actually means to help you with that. So there's lots of reasons why business owners might want to take on a loan. So I'm going to go through some of the wise reasons and some of the ones that maybe aren't as wise or actually frowned upon. So we'll look at the solid strategic reasons first. So on your screen there, you're going to see a bunch of examples. There's others as well, but these are some of the common ones that come up. So of course, equipment or property for a new venture is common, right? So say a new brewery is opening in town and they want to get a loan for purchasing the brewery equipment and a small space for a tap room. Very, very normal. Very good reason to approach a lender for a loan, right? To get that business off the ground. In the same way, an established business might want to expand a bit. So they're getting new equipment to create more capacity. So they're investing in machinery to increase production or maybe increase their service capabilities. Also a viable reason. Expanding into a new market can be another one. So funding the costs associated with reaching out to a new customer base or into a new geographic area. So this might be a business that's expanding into, from Lac La Biche, they're wanting to open up a service office in Calgary or something like this, right? This might be a great opportunity for lending to take care of that challenge. Could be increasing capacity to fulfill a large contract. This comes up a lot in the construction field is a good example. Maybe a framing company needs to borrow some money to get a bunch of new equipment, maybe a new truck, and possibly some new staff to hire a major contract that they're landing with a volume builder. This kind of expansion can come on quite quickly, and a lot of times lending is the way to be able to take advantage of that opportunity. Could be things like bulk inventory purchasing opportunities. So maybe a retail store has the opportunity to capitalize on some discounts by buying a large quantity of goods from a certain supplier in the off season, but they don't have the cash on hand to take care of it, but they know that they'll recoup that in the on season when those goods will sell. Good example to maybe look at some short-term financing for that. Could be acquiring assets to improve efficiency. Maybe this is a logistics company borrowing to implement a new route optimization software system into their systems, just to improve the efficiency of the people that they have out doing the work. And of course, refinancing high interest debt. Maggie touched on this a little bit. This is when maybe you have a bunch of existing loans that maybe aren't the best terms, maybe aren't the best interest, but you consolidate it into one lower interest, more flexible product for yourself to take care of that debt. These are all strategic ways to use debt. And as you can see, they all have a way to move into an opportunity. Now, on the other hand of the spectrum, if we go next slide there, poor uses of business loans. So there's lots of not so wise reasons to go out and seek business loans. And I'm sure Maggie could tell you lots of stories where she's seen these kinds of things pop up. But these are just some examples of when you might want to rethink the business loan. So one is covering consistent operating losses. So maybe this is a retail store or something, and they're wanting to take out a loan each month or to pay their rent each month because their sales just aren't up there enough where they can take care of their expenses. This is definitely not a reason to start borrowing money, as it'll just dig that hole even deeper. Same thing for covering over poor financial planning. So maybe that same restaurant wants to borrow or a restaurant wants to borrow some money to cover payroll after they spent a whole bunch of money on unnecessary decor in their restaurant or something. So using a loan to cover over maybe a lapse in judgment and some poor spending, again, it'll just dig the hole deeper. So definitely not a time to approach for a loan. Another one is speculative ventures without a solid plan. Investing borrowed money in uncertain ideas is a recipe for disaster. So this would not be a reason to approach a financial institution for a loan at that point. Avoiding cuts or difficult decisions. This one comes up a lot. You trying to use debt to postpone necessary cost reductions or strategic changes that maybe the owner just doesn't want to go through with. An example of this could be maybe a consulting firm wanting to take out a loan to keep underperforming staff around instead of implementing layoffs, because that's a pretty scary process to go through. Again, sometimes hard decisions have to be made, and using loans to cover over or push away those decisions is not typically a good use of that product. And of course, then we get into the ones that we see on TV all the time. Using business loans to pay for lavish or unnecessary expenses. So borrowing funds to buy things that are absolutely not necessary for your business and will not create any more revenue. A good example for this might be a small marketing agency that uses a loan to renovate their offices that hardly any clients ever come into anyway, but they want to buy a pool table and fancy disco ball or something. I don't know. They go all out for the 3 staff that they have. Nothing wrong with doing these things. If you have the cash on hand to pay for those things, awesome. Probably make your staff really happy, but definitely not a reason to be borrowing money to do that kind of thing. Make sure you're borrowing for an opportunity that creates revenue. And last but definitely not least is funding personal expenses. This can be very prominent with sole proprietors because as you are the business, like Maggie mentioned before, it's very easy to start blurring those lines between what's a business expense and what's a personal expense. Even if you have a corporation, some people try to play the game that way, but at no point should you be using business loans to fund vacations or home renovations or something like this. Keep business as business, personal as personal, to stay safe there. So just some examples. Don't be seeking a loan if it means over leveraging your business and you can't support a clear repayment plan. That's the basis of all of this, right? But like I said before, there's some factors to consider on the balance of all of this. So I just want to run you through some examples. We said at the beginning, don't go after a business loan unless the opportunity is going to be greater than the cost of carrying the loan. So on the next slide, we'll look at what actually has to be balanced to calculate that out. Because it's not just, how much is the thing I'm buying is worth and how much is the interest going to be. There's a lot more to it. So let's look at both the potential gains and the potential costs that could be coming up if you're taking out a loan for a business reason. So on the gain side, again, just some examples. There's lots of things that we could add on here, but we can only go through some of the major ones. One is increased efficiency and productivity. So this is definitely an opportunity, right? Take, for example, a bakery that's investing in an automated baking line that can produce significantly more pastries per hour than they've been doing in the past, and they can do it with less staff. There is a great opportunity, right? Enhanced product or service quality. So not just volume, but quality as well. So if maybe a printing company wants to purchase a high resolution printer that can offer superior quality prints than what they've been doing and attract a whole new clientele that needs that extra quality. Huge opportunity, something definitely worth taking out a loan for. Could be a competitive advantage, maybe a landscaping company wants to invest in electric mowers and equipment so that it's quieter and it appeals to the environmentally conscious clients. Again, maybe opening up a new door for some new clients and being more efficient, burning less fuel and things like this. That's an opportunity. Expansion of capabilities, being able to open doors to new markets or services or new product lines where you weren't before. Increase volume and revenue. So an example of this might be a manufacturing company upgrading its machinery so that they can see a 20% increase in production and a 15% reduction in waste. Both of those are opportunities, right? That's going to keep money in the business. Or even just preserving working capital. Instead of tying up a large sum of money on a huge purchase, possibly want to use a loan to spread that cost out over time to keep operating capital handy, because as we all know, cash flow is king, and having that extra cash around can mean the difference between getting through an emergency and not. So sometimes that's the opportunity. Now, those are pretty easy to understand. I think where a lot of people get lost is thinking about the costs associated with that small business loan. So you can look at those opportunities and go, okay, if I get this piece of equipment or land or whatever it is, Here's the opportunities that checks the boxes for. I've got all these good things that I can do with it. What are the actual costs that go with that loan? At the top of the list, there is the obvious one, principal and interest payments. That's going to have to be paid, and that is a cost. So, say a $50,000 loan at 8% interest over 5 years, that's just a little over $1,000 a month. And the total interest over that 5 years is probably going to be close to $11,000. That's the cost everybody thinks about with that loan, right? But then there's a bunch of other stuff to factor in. Another is loan fees. Any financial institution will have fees associated with the loans. Maggie would be able to run you through what that would be in your particular situation. But it could be things such as application fees, origination fees, closing costs, payment penalties if you pay out early, this kind of stuff. That all needs to be taken into account. But then comes the things that come along with the thing that you purchase that often don't get thought about when calculating. Is the cost of this going to be better than the opportunity? Another one is taxes that might be associated with that purchase. So it could be anything from land transfer taxes, property taxes, to import taxes if you're bringing something in from overseas, to environmental taxes if it's something that our government has put some kind of an environmental tax on. That becomes a part of the cost of that loan in essence. Insurance is another one. If you're buying new equipment, or property, you're likely going to require some kind of insurance, especially if it's the security for the loan. That needs to be factored in. Maintenance, whether it's vehicles or equipment, there's going to be some kind of maintenance to keep it running. You're going to need to know what that is so you can calculate that into your factoring of is this less cost than the opportunity is going to be? How much does it cost to actually maintain this thing? Fuel and energy. If you're purchasing equipment, you're going to have to forecast those fuel costs or electricity costs or whatever it is into your calculations there. So, for example, I mentioned that bakery that added the automatic baking line to their service. That's a huge opportunity. They're going to be able to create more pastries, but they need to factor in, is there going to be extra costs to running this oven over the ones that they have now? If there's a lot of heat being created because there's more baking going on, do they need to upgrade their air conditioning? These all play in to the final calculation. Maybe it's payroll. If you're buying new equipment or something like that, you're going to need more people to run it possibly, or maybe your staff is going to have to work more hours. Maybe not. A good example of this is, say, a roofing company buys a dump trailer to replace using the contracted dump bins that they've been using for years. Now there's going to be time costs for a crew member to take that trailer to the recycling facility, get it dumped, bring the trailer back. This is all costs associated with that new piece of equipment, and possibly even training costs. If you're buying some kind of a new program or equipment, you might need your staff or yourself to go through some training in order to use it properly, which can also be a cost. So when I say think through, is your potential gain for this thing that you're buying better than the costs? This is what to think about with those costs, not just the cost of the loan itself, but everything that comes with that piece of equipment or land or whatever it is that you're financing. Which again, these are some common examples. This list can be pretty deep, but we're always here to help you think through it if you'd like to. Now, we do have some tools on the next slide. Again, that QR code will take you back to our website, or you can visit atbentrepreneur.com. These tools will help you think through some of that. So there is a business loan calculator there, and there's a cash flow forecasting tool, which is a really good way to kind of project what this purchase and loan might look like over time. Those are both available for you on the website, along with a bunch of other stuff. So I encourage you to check those out. And again, contact us if you have any questions about them or need help with them. With that, I'll toss it back over to Maggie to talk about the nuts and bolts of actually getting a business loan if it does work out that your opportunity is greater than your cost.
Sounds good. I noticed that there's 2 questions in the chat. Is it okay if I answer those real quick before I proceed?
Yep.
Perfect. Okay, so Ron, you asked what's easier to get, a loan or a line of credit? We're a retail store that needs funds in Q4 of the year and can usually pay back around January, February. So to me, my main concern is we always want to make sure that our loan purpose is going to match our repayment. So because we're looking to just ease that cash flow gap, and that it's sounding like Q4 is a bit slower for you and the start of the year starts to pick up, To me, that sounds like a line of credit would be our best bet. We want to make sure that you've got that cash available to help your cash flow during that slow season, but that revolving line of credit will revolve in January, February, and those funds are still available to you in the next year. Now, let's say if we were going to purchase a piece of equipment that would help with that gap, that's when I would suggest a term loan, because we want to make sure that we are only paying the loan back in the usable life of that asset. So we don't want you to buy, let's say, something that will be usable for 3 years, but your loan is for 7 years, or you're on a line of credit where you're only making interest payments and the principal doesn't come down to match. So with that, apologies, Q4 is your fastest. But with that, I would say a line of credit does sound like the best. So that way you can purchase that inventory and then have that paid back in that next quarter. And if you'd like, I can always connect with you after and discuss your specific business and what that would look like with ATB in more detail. So that way it can be a bit more tailored to you in that scenario. And then with Raheel, it said, how can a sole proprietor manage both personal and business activities and books? Is there any system or process in ATB that can advise? So one thing I always suggest is your biggest tool will be your online banking in order to keep sole proprietorship separate from personal accounts. So we no longer merge business and personal accounts in our online banking for that reason, so that way when you log in, you're just looking at your business accounts, holdings, and loans without worrying about your personal stuff carrying through. And then you think that maybe your mortgage is in there when it's a little messier than it should. So we like to keep those two things separate. And then we do have a few payment processing things that can be done on the business side that help, as well as we have our Moneris services that do merchant services that go directly into your business checking account. But again, Raheel, if you'd like, I can grab your email or give you mine and we can connect and discuss in more detail for your specific business afterwards, just so that I'm giving you a tailored custom solution and not a one size fits all thing. We have a few of those with ATB where one size does fit all, but I also want to make sure that I'm giving you the best advice for your business at the end of the day. Let me know if we have any more questions. Thanks, guys. So how do we qualify for a business loan? Our biggest kind of compass, let's say, in determining whether this is going to be a viable business loan for your venture is to look at your business plan. What have you planned out for the next 3 to 5 years for your business? How is this loan going to impact that? What do your projections kind of look like? That QR code will bring you to a page that will show you a template for our business plan. I always like to share the templates with my starters, so that way, even if we're not looking for lending now, it's nice to have that roadmap for yourself so that you know, am I meeting what I planned? Do I need to pivot a little bit here? Is there something that maybe doesn't quite work for me in the moment that might in the future? So you want to make sure that you're kind of putting that pin in it for you to come back to in that 3 to 5 year span, so that you make sure you're on that roadmap. It also contains background information of your business. What is your mission, your vision, and your core values that you look to embody in your everyday business, as well as your market analysis. What is your business doing in the market that's different than what other people have to offer? And maybe what can you take from these other businesses so that we're not reinventing the wheel and we can take others' expertise and apply your own lived experience to it? What products and services are you going to offer? And what do your competitors offer that you might be able to give them something that they don't have? And then your financial projections. What is your best case scenario for your next few years? And then I always like to add, what's your worst case scenario? And maybe a backup plan for if we do have that worst case scenario coming to fruition, what do we have that are our strengths and opportunities that we can use at our disposal to make sure that we are kind of pulling the plane up, is how I like to use that metaphor. And then how do we qualify for it? So credit worthiness. We've talked about your personal credit score, and we use these for all business loans. So if we do have a corporate credit bureau, we are still going to pull your personal to speak to that joint and severally liable, just to show that this is how the business has been operating and this is how the personal has been operating. And then we merge them together to say this is how we expect the business to pay this loan back going forward. We do have minimum FICO scores for our new and existing borrowers. So if you are a new borrower to ATB, we do require a score of 650 or greater. And then for existing borrowers, 620 or greater. So that's one of my main questions is, do you know what your FICO score is sitting at? And if not, let's take a look at that. And then we can go over that credit bureau and see what do we need to improve on, or we're good to go and let's go forward. Business credit score, we'll pull that, discuss if there's any judgments on there, what happened, get a bit of the background, and then that's when I can discuss with you, is this something that we can go forward with, or is this more of a not now, but here's how conversation, and that we can't do it today, but how do we get to you to a spot where we can do it for you in a year? And then the 5 C's of credit. Ooh, I thought I had more about the 5 C's. So our 5 C's are character, collateral, capacity. Those are my main 3. So our character, have we paid our loans on time? That speaks to our credit bureau. What is the character of the management? How do you present yourself, and how have you made your agreed upon payments and all of those other things? Collateral, what are we using to secure the loan with? Is it unsecured? That's fine. We have something called an all-PAP registration, which stands for all purchased and after acquired property. So that means that anything the business owns now and in the future, we could use as collateral. And same for your personal, which is that joint and severally liable thing. And then we also have capacity, which I have a slide on, is how can the business make these loan payments? Is it comfortable? Can we debt service? And then how do you as the business owner also have the capacity to make these debt payments? So this is one of my favorite ratios to always bring up to people, is your total debt servicing ratio. This tells you, am I ready to take on this loan with my personal debt obligations, adding on the business as well? So your TDSR is a financial measure used to see how much of a person's income goes towards paying their debts. It's used to assess your borrowing capacity and gives you an idea of what your personal cash flow will look like and how it will be affected. So I always like to do this with my personal budgeting every month, just to make sure that my TDS has not changed on a monthly basis. And I always like to encourage folks to just give it a try and calculate it. So it's, what are your monthly debt repayments that are required? What is your rent, your mortgage? Add property tax in there too if you have a mortgage, your credit card minimum payments, your term loans, phone bill, etc. And add that all up to be, what are you paying for your debt every month? And then I want to take your monthly income, and we're going to divide those two and times by 100, which will give us a ratio of what percent of your gross income goes towards paying your debts every month. And at ATB, we usually have a guideline of less than 42%. This is mitigatable. Let's say we've got a strong personal net worth, we have a great credit bureau, but we've got a little bit of debt on the personal side and we need a loan to start up our business. And our TDSR, let's say, is 55%. We can mitigate that. That is not a stop to our loan, but it's something to be aware of what does this look like for you to be severally liable for this loan, and what would it do if you had to make this loan payment personally and not rely on business revenues to pay it. So it's one thing I always like to have people be aware of. It's one of those ratios to calculate and see, can I service this? Is that number, that ratio, a little nerve-wracking to me, and why? So I always like to have this for capacity to see, what does that feel like for me, and is it comfortable going forward? So yes, our 5 C's of credit. We have character, conditions, collateral, capacity, and capital. So collateral is the security for the loan. It's an enforceable legal claim on the collateral that have been pledged as backing the value of the loan. And usually it needs to be a one-to-one value. So if we're putting cash on hand, we need to have the same amount of cash on hand that we're going to use for the loan. It's typically registered in the form of a charge, and a charge is an agreement between the lender and the borrower in which the particular asset or class of assets can be used as security. So that speaks to that all-PAP registration, where if we have that all-PAP going forward, we can add inventory, receivables, accounts payables to that as adding backing to that all-PAP registration clause. We can also add serial numbered goods like vehicles and equipment. And we can also add, like I said, cash on hand in form of a fixed date deposit or GIC. There's many different ways to make collateral, but it's not a requirement of the loan per se, because we do have that all-PAP general security agreement. So we always want to make sure that our collateral is fitting the purpose of the loan as well as the lifetime of the loan. So, great example is a vehicle. We only like to use vehicles as collateral for about 7 years because we know that that is a depreciating asset and we don't want you to pay off a loan for that asset after it's depreciated from its useful life, let's say. Of course, that truck is still going to be on the road, it's still going to be running, but if we can't claim it on your balance sheet as a depreciating asset, we don't want to make you pay that loan for it. So we always want to make sure we're matching those terms to the purpose of the loan. And then choosing your lender is a big thing. And I always like to say that, of course, with ATB, we want to be your partner, but at the end of the day, we want to make sure that the partner is going to work for you and it's going to fit your needs. So find a bank or a lender that understands and will work with you as a partnership going forward. I don't ever want to be the big bag banker. I want to be your friend at ATB that's supporting your business. And that's my main relationship that I'm looking to build here. So discuss pricing. Make sure it's going to work for your total debt servicing. Make sure that it's going to work for your capacity and that the collateral is going to work for you as well. Ask about your early payout options and fees. So great examples, if we're doing a mortgage, that will have a payout penalty of about 3 months of interest. So make sure you're discussing what happens if I want to pay this loan off a little bit early? What happens if I want to make extra payments to this loan? Am I free to do so? And what do those penalties look like if they're there? I always like to make sure we're addressing that so that way we're setting up the loan structure to meet not just your needs right now, but your repayment needs in the future too. And then determine what value added services they can offer you as well. A great example is that payroll software that I mentioned, or our tax payment service, or our cash management services. Go with the bank that's not only going to give you the loan, but is also going to fit your business's needs in that relationship. You don't always have to be fully banked with one banker, but it's best if you have a go-to bank to have that relationship with, and they can help be an advisor going forward. So here's our information, and I can give it to Cliff to wrap up that last little bit.
Awesome. Thanks, Maggie. So yeah, that's kind of a crash course in some of the important things to know when it's keeping track of how your business is doing and the potential of getting a loan to forward your business. As we mentioned, Maggie is a business banker, so she would be the one to talk to if you're looking for the nuts and bolts of how to go about, taking care of your business banking needs or your cash management needs. I'm more of a business general strategist, so I work on that end, kind of connecting you to resources that you may be able to use in your community. We do have some time left over, so we could open it up to questions if that's okay with you, John.
Yeah, for sure. Yeah, we do have a lot of time. If there's any questions, feel free to ask. If it's a bit private, you can send me a personal message on Zoom, and I can ask for it, and I'll keep it anonymous.
Well, thanks for that feedback, Monique. That's awesome. I'm glad it was helpful for you.
Also, if any business owners like Ron or Raheel want to have an appointment with me later, please feel free to use that email and send me a message. I would love to get a chance to either meet with you in person next time in Lac La Biche or just schedule a quick call so we can discuss this in a lot more detail and a lot more tailored to you and your business too.
All right. Well, it seems like there's no questions here, but both of our emails are on the screen, or you can contact us through our website or through John. John knows both of us really well, so he can hook you up. If we're not the right person within the ATB to answer your question, we'll be happy to connect you to the right person, and we can also connect you to organizations outside of ATB that may be helpful for you if we see that could be the trick for you too. So feel free to reach out anytime. Yeah, I don't know, John, if you had anything else to do, but doesn't look like there's any questions coming in. So
Yeah, yeah, I think so. Yeah, I think we're good now. Thank you everyone for joining us this lunch. I think we finished a bit early, so we still have free time to do personal stuff, I guess. Thank you so much, Cliff and Maggie, for joining us, and thank you everyone for taking the time to join us. Yeah, I guess see you. the next workshop.
All right. Thanks, John. See you all later.
Okay, see everyone. Okay,
Thank you
bye
for
bye.
joining us. Bye.